Hi everyone, this is Akshara Menon from PMSBazaar. Today's session it's going to be a very relevant and exciting topic. Why invest in startups for wealth creation? If you look at current environment, public equity markets have been increasingly volatile with frequent swings driven by the global cues. As a result, many investors today are actively looking out beyond traditional markets in search of more differentiated and long term growth opportunities. This is where private markets have started gaining a lot of attention. Startup investing, in particular, has evolved from being a niche, high risk space to becoming an important part in the investor's portfolio. At the same time, it is important to acknowledge that this space is not without risks. Higher failure rates and recent valuation corrections have made it clear that the disciplined and structured approach is critical. What's also interesting is the mid-stage private equity, a space where companies have moved beyond the initial certain uncertainties and are now in the growth and the scaling phase. This offers investors a balance between strong upside potential and relatively a better visibility on a business performance. So today's session will break down this how to think about startup investing and how private markets fit into your overall portfolio and how to approach this both early stage and mid stage opportunities in a both structured and informed way. To guide us through this, we have more experience and expert with us today, Mr. Vinit Rai, Managing Director, JM Financial's Private Equity. Vinit has been with JM Financial since 2006, brings over 2 decades of experience, including 16 plus years in Indian private equity investing. As a founding member of JM Financial's Private Equity, he has been instrumental in building a platform through early and growth stage investments and successful exits. His sector expertise spans with financial services, education, manufacturing, F&B, agri-tech, consumer services with hands-on involvement across the investment cycle. So, with no delay, let me give the podium to Mr. Vinith. And before that, all the audience, put your questions on the chat box or Q&A box that's seen there before you. And these questions will be taken post the presentation. Over to you, sir.
Thank you, Akshara. Thank you for the introduction. And thank you, everyone, for joining the webinar. Before we get on to the topic, a quick, introduction about me, other than what Akshara shared is, basically I'm, born in Lucknow and brought up in Mumbai, around the Shivaji Park area. If, you're familiar in Mumbai, it was basically the cricket in Mecca, Sachin Tendulkar, Dilip Vengsarkar have all trained there, and touchwood, they have been part of World Cup winning teams. I was also a budding cricketer, but couldn't make it. But one thing I learned from there is that, partnerships are extremely critical, as just like in cricket matches, and private equity startup investing is all about actually building, partnerships. So one thing led to the other. And as Akshara said, in 2006, I was privileged to join this industry, which was very nascent at that point of time. And of course, it's been an enriching 20-year career in this asset class. So with that, what I would do is that I will kind of use a few slides for the topic today, so it becomes kind of, a little bit easier to structure the discussion. Thank you. So as you would see the title, I've kind of, it's why and how to kind of invest in startups. So uh, because you guys are from the finance world, I think the basic mantra of any, investment is risk and return, right? So if we want, if we want to go and invest where the principal is safe, such as in fixed deposit, etc., of course, we will also get the usual 4, 5, 6% return, right? Whatever we get, right? And of course, if we want higher returns, just by the basic fundamentals of finance, you have to take higher risk, right? So that is how the world of money works, and nobody can make an exception to it. Of course, as fund managers, we are always attempting to make alpha, where you kind of minimize the risk for the returns you're targeting. So with that basic philosophy in mind, the slide that you obviously see on the screen is from a return perspective. So where, of course, if you are investing in, IPOs, typically these are large companies, and of course they've kind of, most of them should be highly profitable and so on and so forth, and have built significant scale. So there is no real risk left for the business to be getting disrupted massively. So which is where, of course, the returns also, typically are, maybe in the teens somewhere, right? And of course, benchmark to Nifty, etc. So because the risks are, of course, lower. As you go earlier as a stage of business, which is say pre-IPO or then growth stage, or if you started from the other side, right, when the business is like a seed stage, then it goes to venture and then early P, late P, etc. So, of course, the highest risk is at the seed stage, where suppose any one of you participants raises their hand and said that I want to start this, deep tech business, and then how many of us would be willing to fund it just at that stage? Because the risks are very high. We don't know whether it will kind of, see the light of the day or not. So, of course, the basic thing is that higher the risk you take, which means lower the size of the business when you're investing in, typically your potential of, making returns is higher. Just so that's what it kind of, says from seed to kind of, public markets. In terms of private equity overall as an asset class, especially for India, it has not been easy. But just to kind of give you a background, even globally, it was never easy, right? So if you see the US markets, etc., their in private markets journey started much before the Indian markets, maybe in the 1950s and 60s when. So even when the Googles were born, they were also, running here and there for capital and so on and so forth, right? And even investors there lost money, etc., etc., till it kind of, of course, matured and became a very deep ecosystem. And then consistently over the last, 15, 20 years, the private markets have created an alpha over the public markets. Coming to India, of course, again, India, it has been a young industry. It started very much in the late 90s or early 2000. And then the asset class was kind of gifted with the global financial crisis. So it was my early journey in the investing world, private equity, and suddenly you see everything go haywire, profits dropping, companies getting into losses, and so on and so forth. So clearly the asset class took a back seat. And then of course, it took some time to rebuild, maybe around 2014, 15. And then, of course, the asset class started building back, So to give you a number, I think it was $7-8 billion industry till 2012, 13, which then suddenly over the last 8-10 years has jumped to, $25 billion plus as an asset class annually. So clearly that means that lot of more and more investors have started, putting something in this asset class, because the main reason being of the exits have also started happening. So, I mean, it's a relative term, but at least compared to the number of exits which would have happened, say from 2002, 3 to 2014, 15, the last decade has been much better. So when exits happen, money goes back to investors. So of course the money comes back to the asset class as well. That's the usual psychology. So of course now, I think it's kind of matured, and I think every 5 years I feel that the asset class will only become stronger and stronger, with both entrepreneurs also becoming more structured, and as well as, of course, LPs starting to believe more and more in this asset class. So this is kind of the space which in India is more structured, like, right? Of course, so you got the 5 million or below ticket size, where a lot of angel networks, seed investors, early VCs kind of play. And then, of course, you have the other side is where larger PE funds who have kind of, succeeded, very well in the US, etc., have come to India to deploy like 30, 40, 50, or even 100, $200 million in a single company. So these are the two extreme asset classes. And then, of course, there is one asset class which is in the mid market, where businesses are not as early as seed stage, but they are not as big as, of course, the late stage as well. So they are somewhere in between. From our perspective, we define it as, companies typically in the revenue range of 50 crore to 500 crore, where this kind of asset class is there. So it has its the risks are lower and return potential is still, of course, strong. So that's the asset class where JM, of course, has been playing in for the last 20 odd years. I think coming to our, topic now, of startup investing, I think extremely critical. I think it all boils down to, and I'll start with the common mistakes, just like, any other thing which we look at. I think first thing we need to kind of avoid is the specific, very basic mistakes that can happen. And, I would start with the emotional side because this is the toughest to handle. Even I think, as a lot of gurus say, that even on the listed side, most of the losses that investors incur is because of their own emotions. So I think startup is no different. I think the challenge here is that and here one more element of complexity is that at least in the listed world, you click a button and you can just exit a stock, right? And so it works both ways. I think sometimes I feel it's a good thing that on in the startup ecosystem you can't do it, because sometimes just you would exit a stock not at the right time. So but on the other hand, of course, because it's illiquid, the situation can get fairly tricky. So the first thing that one has to do if he's looking at the asset class, which is the startup asset class, is that be emotionally prepared, right? The first two kind of the time horizons, and the preparedness emotionally to deal with high volatility in a startup portfolio that he's going to start, right? In fact, interestingly, the AMFI and other regulators and all the industry associations of mutual funds have done a phenomenal job on market education by saying mutual fund sahi hai. And you kind of, you see, I'm sure you must be watching all those Rohit Sharma ads, where he's saying ki lage raho, pitch pe date raho, and don't sell your mutual funds. I wish the same education, organizations like PMSBazaar and others can do on the startup side, that even when you are investing in mutual funds, which are, typically in businesses which have very high market cap and high business, strong raw revenues, they're advocating a long-term hold, right? That you need to be there in that mutual fund for a long period of time to really see returns. Then the business in the startup ecosystem is, of course, much, much smaller than the listed side, right? So I think that is the most important thing, which and a potential investor wanting to create a startup asset class portfolio should keep in mind, that he's really parking money for a long period of time. So if mutual funds are now advocating, say, 4 years, 5 years, then this is even longer time to because the business has to get to those stages. So you should not be parking money which you will need, right, in the next 3, 4, 5 years. So this can be long hold. So I think this is the basic mistake which I see a lot of investors have made, and they are very, very frustrated about that, oh, it's been 5 years, it's been 4 years, I've still not got my money out. But it is not meant to be like that. This is an asset class which is going to take long, right? So it's you there is it is just the way it is. So it's very important that you prepare yourself emotionally for real long holds when you are looking at this asset class. And then the third, again, extremely important is that a startup asset class, like even when we invest in a mutual fund, right, there are so many underlying stocks, right? And well diversified, again, at larger scale of businesses. Whereas what I have seen is a lot of people have just invested in maybe 3, 4 startups, and then 3-4 years nothing has really happened, and then they say that, oh, this asset class is just not for me, and then they leave the asset class, and because of their concentrated exposure and nothing much happening there. So that is again a big mistake when it comes to startup investing, which one should completely avoid. It is clearly an asset class where you need a I mean, if I have to put a number, a minimum 10 to 15 company portfolio for you to judge the performance of the asset class, rather than just running towards 2-3 companies and then passing a judgment on it. So very important to avoid concentrated exposures in the startup ecosystem. That's again critical. And then of course is the also when you're investing in startups, I would still urge that if you should kind of, maybe if someone is from, say, an FMCG background, you run an FMCG business yourself, you created cash, or if you been a big CXO in FM, so you understand the sector there. So then better you kind of start with startups in those sector which you really have done some work in, as a professional or as a businessman or whatever it is, right? So it's important that you, at least your initial journey is in familiar territory. That is extremely important, which again, I don't see, right? People have invested left, right, and center in businesses that they can't even, explain that, okay, I've invested in a startup which does this. So, which is again a big, mistake that has happened. So, which I think one should avoid. And then, of course, is the burn estimation or whatever is the growth, amounts that is there with the company after the round is done. How long is it going to last, and so on and so forth. Again, gets heavily, not understood properly, and that's the reason that a lot of investors then are not happy after making those investments. So these are a few things which I think we should keep in mind to avoid as mistakes. From a sophisticated investor perspective, so typical AIFs who are focusing on this kind of asset class, look at these criteria, right? Which is I mean, nothing very uncommon, but just to kind of elaborate, of course, the market opportunity. So what really could be the demand supply dynamics, right, in the company you're evaluating? Is it really a large market, and where there could be multiple players? But then if is the market demand in billions of dollars and so on and so forth, right? So, and the growth rate extremely important. Or if it's a slightly niche market, then is it that it is the startup is kind of disrupting an old industry, and in that he's kind of in the top two, top three. So market opportunity needs to be understood very well, along with the competition, which is where a lot of work goes, from the professional side when they are working in a VC fund, or a startup network, or say even if I am personally investing in a startup. So that's extremely critical. And then, of course, is the understanding the moat of the business, right? What really is the differentiating factor? Because a lot of times when a startup is bringing a new product or service, in the founder's mind, it seems very new. But if you go and talk to customers, it will be a very different idea. So because they have been fulfilling that need in a certain form any which way. So it's not that without this product or service, they were not existing. So it's extremely critical on what the new product or service the founder is talking about is really understood from the point of view of the customer as well. So that you can clearly understand the differentiation the business is bringing to the table from a customer point of view, and that, and how will it hold. So if it succeeds, then why will it kind of remain differentiated, and why competition will not come in and try to disrupt this business. So that is extremely important, and that's what, of course, professionals pay a lot of attention to. And then fourth is exitability, again very critical. I think all of us here ultimately are buying shares not for holding them forever, but to sell them at some point of time. So exitability analysis is extremely critical, which fund managers have to work on in this space, because as AIFs, as SEBI registered funds, we have a finite fund life. So we all, as investment professionals, have to really focus that, okay, if the business grows extremely fast and actually goes public, great. But if not, if it is not growing fast, then what is my backup exit strategy? Is it going to be a strategic sale to some other, some other larger player? For example, if you are looking at a startup in the D2C personal care space, is it that a large giant FMCG giant like a Dabur or a Marico will buy it, etc.? So all those things have to be very well understood, before you actually make the bet, because as we all know, we are all here to kind of sell shares at some point of time, and that's why we are here to buy. Otherwise, if exitability is not clear, or no, then it's a challenge. And then fifth, of course, this you must have heard everywhere: founder. I mean, even after 20 years of doing all this and having met maybe 15, 16,000 entrepreneurs in this duration, it's never easy, but you really need to do a lot of work of, understanding the background of the founder, what really is his, capabilities. So how is that capability relevant to the business that he's doing? So for example, if a very simple example is that if suppose he's planning to launch say a retail chain of pet care stores, or he is thinking retail. So is it that he has some capability, etc., that he has done retail earlier, he understands location very well? So the critical success factor of the business needs to be kind of mapped to the skill set and capability and past experience of the founder. I think that's one thing, at least as a tangible thing, I can share. And then, of course, the other softer aspects, integrity, hunger, willingness to share, all the other things, of course, come as well. So, uh, in fact, in the startup stage, I would say of the fifth point here plays like maybe a role which is combined one to four, because it's extremely critical. Yeah, so that is extremely important from an investing criteria point of view, and need to do a lot of work on the founder. And then, of course, just kind of towards the last slide before we get into Q&A, and how and when should you do it? Is again, once you invested in the startup, how do you really monitor this portfolio, right? Very important, because it's not like the listed companies where, you can quickly see quarterly results, or once a quarter P&L, balance sheet, cash flow. And, then of course there are some research reports which talk about the stock, and then you can have a view. It's extremely different. And because the stage of the business is also very, very different, right? They're very early in their thing. So it's here, the most important thing that becomes is that you, of course, keep looking for disruptions that may happen, in the sector, which, on the macro side, which you need to keep track of that a little bit. And then, of course, very important is the business plan tracking. The founder has given a certain plan, and that's something that needs to be tracked, that, okay, how much are you away from your budgets, etc.? What is your cash situation like? So very, very critical to keep looking at that, because there's no share price here to look at. Right. So it's not like the listed market where you're tracking the, okay, 52-week high, 52-week low, relative comps, where the, is the industry trading at 30 times P and the stock is trading at 25 times. Those things are not really there here and not relevant either. So this is what you need to track in terms of business plan, how the company, and initially you will see that the founder will miss his targets, but that's where you keep talking to them, and then over a period of time, the founder will come as close to the targets he is giving, to the board or to the investors, and so on and so forth. And then, of course, the systems processes come along with it. And most important thing, you have to also keep gauging what is the founder motivation over a period of time, right? Is he really getting tired, and is he feeling more hungry? What is happening? Again, as I said in my previous slide, a founder is really, really, critical, just like Vidya Balan's entertainment. So that, of course, will continue to be, other driving factor. So this is more on the content side from the slides. How and when to start this also, maybe we can take it as a part of Q&A in the interest of time. So Akshara, I think we can just open the floor for questions.
Thank you, sir. I think like the way you start off saying that mutual funds say here, and I think government has been promoting it, and even
Yes.
you compare that with PMS Bazaar also. I will tell you, 9 years back when PMS Bazaar was just a startup, which was just
Right.
started. Yeah,
Right.
most of them didn't know what was PMS only.
Yeah.
So in this 9 years or almost
Correct.
in a decade, the awareness PMS Bazaar has created to the industry is immense. So I
Yes,
think
absolutely. No,
that
well
part,
done, guys. Really. No,
yeah, I
very
think that
important.
part
I
is,
think that's extremely critical. Yeah.
yeah, and it's as critical as for investor to stay invested as well. I
Yes,
think
absolutely.
that part was clearly explained by you. And of course, you're always mentioning the part founder. I think here what matters more is to trust on the founder.
Yes.
And trust doesn't come overnight or over a
Yeah,
day. I think that is where you need to understand the business model. Yeah.
correct.
So in that sense, startup investments have a longer gestation periods,
Correct.
and of course higher failure risk. Yeah.
Absolutely.
And so, what kind of an allocation should a investor should give, and what is the how he or she can manage downside risk here?
Yeah, yeah, absolutely, Akshara. So, which is very perfect. So, that anyways was the part of the last couple of points for webinar. So when do you really start, right? So, I think clearly, this since this is the highest risk asset class one can ever, imagine. This will so typically when you see that an investor has kind of moved from say fixed deposits to at least listed securities, so and then typically in the right sense you would start on with say Nifty, buying Nifty, right? Because that's the safest in the listed bucket, right? It's the index itself, right? So it can never get illiquid and all that. And then you get to say mid cap stocks, which is again in the listed stock, and then you get to small caps. So this is how you're traveling your own risk journey in the, and of course then PMS, etc., right? Depending on what kind of strategy you want to run. So you are running on a risk journey on the listed side. So when you kind of you understood the risks at least in each of these a little bit, then maybe you are more mentally prepared to get onto the unlisted side, and then you have all those, either you do a pre-IPO company or a mid-stage PE fund or or a startup, etc., right? So clearly once when you're doing your asset allocation, and also it also depends on what is your balance sheet size, right? Because we all have a certain level of operating expenses. So if your balance sheet size is small, then you will not get into those kind of risks immediately. But if you already reached a very, say, a three-figure, balance sheet side, if you're, typically say a 10-15 million dollars and above, then that your regular things of life, etc., are kind of taken care of, and then your exposure to higher risk assets kind of increase because you can take those kind of, raise, because it's not going to affect anything badly, right? So that's how one starts to think, and that's the right way of thinking. And then when suppose you start, so I typically always feel that if you invested 100 rupees in the listed equity portfolio, right? So maybe you can start, with about 5 rupees somewhere here, right? Because then if your overall listed portfolio, whether it's listed mutual funds, listed PMS, listed direct equity, all put together, say for just to kind of take a numerical example, is say 10 crore as an example. Then maybe you would start with 50 lakhs in the hardcore startup ecosystem, because that is a wallet that 50 lakhs you will be open to kind of out of that 50 lakhs, again again how do you allocate that? That's what I said in my early slides, that minimum you need to have say 10-12 investments, right, over a period of time. So if suppose I'm investing 50 lakhs in year one, and again through a period of time, so you should minimum have a 3-year horizon to complete your startup investing portfolio. So if I have to give a very basic thing, do one every quarter for 3 years. So you invest in say 12 startups, and hopefully if you have 50 lakhs every year, nothing like it. But even if not, suppose it's 1 crore over the entire 3 years. So you invest say 8 to 10 lakhs in, 10 to 12 companies over a period of 3 years.
I think that clearly explained about the investors' risk appetite.
Yeah.
Correct. So while answering it, you mentioned about a investor moving from FD to listed equity, and from
Yes.
listed equity to PMS, I mean direct equity to PMS, and then
Yeah.
alternatives. So in that front, if an investor, I'm just giving a hypothetical situation, if an
Yeah.
investor who's completely new to he's even new to public markets, but he's approaching you
Yeah.
to have an exposure in this either VC or a PE fund. So
Yeah.
what is the advice that you would give to him?
No, no, exactly. So I think, the advice is again, so we have to be very clear, right at the start, right? That risk and return, you have to be very clear that if what kind of return are you seeking, and accordingly you take the risk, right? So if you're really wanting to allocate capital to, change your lifestyle, because startup investing, when it rewards very heavily, right? So for example, my own personal case, when I had invested in a company called as Karza Technologies in 2016, as a startup, and then in 5 years, Warburg Pincus kind of Perfios bought the company. It made 55 times money in 5 years for people, right? So that was life changing for a lot of people. People could buy their homes, etc., etc., right? So that kind of money got made. So, and that happens. So point is that when you are coming to me for so if you are looking for those kind of returns, then of course you will have to allocate something in very very early stage, right? But if you're just coming to kind of beat the market returns, etc., then maybe a mid market, etc., is good, so is good enough, right? So depending on your own goals, you need to kind of, and being aware of the risks also, right? Both sides work in life, in equity investing. You then kind of approach this situation.
And actually, you yourself said that the returns that you've gained back in 2016, correct?
Yeah.
So I'll tell you, startups are failing, at record rates post COVID, which is
Yes.
2020. Yeah,
Correct.
as
Yeah.
and for investor, okay, who have entered the market in 2021. So
Yeah.
how does the portfolio look like?
No, so I think, yeah, again, market, I mean, again, we are more referring to, younger businesses, startups. Clearly, the situations have changed a lot, both on the business side and the funding side as well. So, businesses have changed, and every few months something new is happening. So, of course, depending on, which vertical the startup or the early stage business is in. So things are changing very fast. So that's where I said that, your evaluation of the founder becomes extremely critical. So, depending on what kind of businesses you've chosen, the results will show up. And the other side is, of course, the ecosystem itself. The funding ecosystem has gone through its own challenges as well, right? Through the funding winter and all of that. So I think, and that goes through its cycles. It's something which, it's not that it has happened for the first time, and it is not that it will happen it's happening for the last time. We all know that those cycles will come and go, right? So I think currently we are, unfortunately, whatever can go wrong is going wrong, as we can see, right? In and around our, so I think that it will be looking tough for everyone now. But as long as you are invested in a good business and good founder, I think the Rohit Sharma advertisement की pitch पे खड़े रहना जरूरी है will hold true here as well. And I think, yeah, and then once the cycle turns, I think a lot of businesses and stocks, even on the startup side, should do well.
Yeah, I think I accept the fact that everything is cyclical. Yep.
Yeah,
There's no one bull side and there's no one bear side. I accept
yeah,
that.
yeah,
But there's some fact that also to be accepted. You've been in the industry for so long, from
yeah,
2006. So
absolutely.
the returns or alpha, which was given by this private equity as an asset class
Yeah,
back in 2016, 17, or even for 2006, so that fatter, the alpha is significantly reduced.
sure.
That from 16% to 14%.
Yeah.
So Do you think it again have a reverse side of it going back to the back, 21, 20 to
Yeah.
25 percentage?
I feel strongly about it. I kind of feel very strongly about it because I think what's happening is, that lot of learnings have happened over the last 2 decades.
Yeah.
From a fund manager perspective, lot of new shops have also opened up who are doing investing, etc., etc. And I think the only hope here is that people with the right expertise get into the space, and that is where, of course, as an investor, you always have to be cautious and you study the background of the professional you're backing. But having said that, if that kind of prevails, the entrepreneurial quality is also becoming better and better. And I think the M&A ecosystem is also becoming better. A lot of now, in fact, secondaries funds have come up. So the ecosystem is deepening. So and in fact, this is what we told our LPs when we did our third fund in 2023, and touchwood, things look really good. That over the 2023 to 2033 period, I think we see significant alpha return to this asset class. Simply because of the quality of investing, the quality of monitoring that is happening across companies, and so on and so forth. So I feel quite confident about it.
Fingers crossed. And I'll tell you, Indian fund managers are always bullish on India. There's no other way around for that. There's no two-side coin. It's only one side for Indians. And it's not a biasness, but probably it's a fact that, of course, India is booming, so along with that, companies also will boom. So I'll just
Yes.
take one question from Praveen. Generally, a startup investment ticket size is bigger, not for retail investors. How do small investor who wants to invest, investment is, pans around 5 to 10 lakhs, to
Yeah.
invest in startups, and how he or she can go about it? If you want to
Yeah,
take
so
that.
sure. Yeah, so I think that is where I think now again, as I was referring to the ecosystem, I think there's so many angel networks that are around, right? And that their only job is to kind of keep looking at entrepreneurs, and they filter the opportunity, etc., and then they take it to market. So those clearly offer a ticket size of 5 to 10 lakhs, is I'm clearly aware. So that is one way which you can start, and then of course, and then there are so many websites also. In fact, even crowdfunding websites, etc., where you can so that I think availability of deals is not an issue at all. So that challenge is not there. But so that is one aspect which you can look at, or if you have a Vinit Rai kind of a person in your personal network, professional network, you can always piggyback on people like them. That's also a possibility. Like typically, that's what happens with me. That if I'm betting on something, for example, we did something in the mental health space somewhere few months back, at a small ticket. Then of course, friends and family kind of come along. So these are the two ways you can do it. But of course, from a structured approach, if you can approach angel networks. And a lot of individual websites, etc., where a lot of business ideas keep coming, which would very happily take a small ticket size investment.
And generally, there's a always comparison between public markets and private markets. In that front, the valuation is well known in the public market. The data is available in public.
Yes,
But for private market, that is not the case. So
correct.
only the investor who already invested get an update about his portfolio or about the
Absolutely.
market. But
Correct.
a third person who wants to invest or who's willing to invest, but still he or she is not aware about. So how where do you create the awareness, and what are the metrics should an investor look into before he is investing?
Yeah, yeah, exactly. So I think again we spoke about it a little bit in the earlier part of the discussion. But if you are say new, I mean you ideally you should, and there are enough deals in the market. So and there are enough bridge opportunities, etc. If you're really starting off, maybe look for companies which have already raised a round of funding. So you are not the first one to go and back that capital. I think because if you're so new to the asset class, I don't think you should, kind of, do that, right? So you basically look for companies which have already raised, say, a small series, even if it is $500,000 or so, at least 12 to 18 months back, and are now raising another round, right? And that's where you kind of, so because then you know that the business has at least survived for a couple of years after raising the first small round, even if it is like 500,000. And then when they are coming back to market, for the 1 million, 2 million, and I'm telling you, in this market, everyone is accepting even like a 5 lakh ticket size, right? So, so that is where you should start, because then at least your mortality risks is lower, Akshara.
Okay. And I'll just take one question from Ravi. Sorry, from Ravi saying, could you please throw light on how different it is while comparing it with micro and listed space, micro cap and listed space, but in scalability perspective, which is startup and a micro cap and listed space. He wants to understand the difference in a
Yeah.
scalability perspective.
Yeah, again, so very different. So even in the micro cap listed space, I think typically at least you will see businesses that have crossed minimum 150 crore of revenue, right? So even in the microest micro of the listed space, they are real businesses, right? Unless, of course, unfortunately, if you have gotten into a stock which actually has no bill, which of course earlier, last 25 years, some scams have happened. But leaving that aside, typically all these are genuine businesses, right? Which are there, and typically at least generating profit after tax, right? Even if it is 3 crore profit after tax, 5 crore profit after tax, they're all generating cash typically in the micro case. So the scale is extremely different. Whereas when you're talking about startups, which is early stage, they are maybe now just reaching the first 1 crore monthly revenue, and profits are very rare. Even if it is rare, or maybe you just break even. So we really can't, look at it from that lens, because there's anything that you look at from a listed perspective, because of course of the regulations, etc., will have larger scale compared to startups. Of course, the difference is that the growth rates will be very different. So when you are investing in a micro cap, etc., say it is growing at its P&L revenue, etc., at 30% compounded annual growth of rate, startups might grow like 5 to 7% month on month, right? Not 30% per annum. So that's the whole risk return reward we are talking about.
True. I think when you expect bigger returns, of course, the risk would be more. I think
Yeah,
that is taken. And let's come up to sectors.
yeah,
Most of the global PE funds are sector focused. If I could take names, KKR or owns infrastructure, and Warburg
yeah,
owns healthcare, and
yes,
CK owns this consumer tech. So, but when it comes to JM Financials,
yeah,
it spans around agri tech, FMB, and
yeah.
BFSI and consumers. So you're into more sectors.
That's correct.
So don't you feel that being sector focused will have a better IRR or better returns because you're going to use the sector on a whole?
Sure. No, thanks for that question, Akshara. So I think we look at it in two ways. One is, of course, again, we are also not in unlimited sectors. We have our focus 6 to 8 sectors. So it's not that we don't have focus sectors. We have focus sectors, but we are not a one sector fund, clearly. And the rationale, and that has touchwood worked very well for us as well, is that what happens is that during a lot of times, certain sectors just go ahead of their times in terms of valuation. So I'll give an actual example without naming a company, of course. This is just right out of COVID, and, D2C brands were, on the personal care side, going crazy. And, we gave a term sheet to a brand at almost 3 times revenue, and the brand refused, which was a shock for us because we typically don't get refused, right? And but we were disciplined about it. We said, okay, if D2C personal care, maybe the business is good, but the valuations are looking stretched. We said, okay, fine, and we did not deploy capital there. We in fact went and deployed it in the packaging sector, right, at a
Okay.
very very reasonable EBITDA multiple, etc. And touchwood, that has given us 40% plus IRR and so on and so forth. So I think what happens is that when you have a few sectors to play with, and if you build expertise across a range of sectors, it gives you that flexibility that if one or two sectors are going, haywire in terms of crazy valuations, or are going through some headwinds in that businesses, etc., you can just go and invest in the other sector. So that's what has worked very well for us.
So it's a question of curiosity. Is there any deal or any company that you missed but you regretted later?
Absolutely. Oh, many.
Get some examples.
Sure. So I think one which, in fact, that company is going to go public is what I hear in 12 months, and what we
Okay.
is a company called Leap India, which is a pellet company, and
Okay.
so extremely interesting business. So they kind of manage the pellets for the FMCG industry and all that. So that had come to us, about 7 years back, and then but I couldn't build my conviction, and that still pains a lot because we could have made unreal money there, from that. In fact, the name that you took, Akshara, interestingly, KKR is now a very large investor in that company. So
Okay.
because it's kind of an infra leasing
In-
play. So as credit to you, your knowledge is right. So that's how. So that company from a very young stage actually has reached a stage where KKR came in, and now it's going to go public. I think in the next 12 months or so. So that's a bad miss, of course.
No, but so, I don't think either it's bad or something. Probably there's something good waiting for you in different
Yeah,
sector, if not
of
infrastructure.
course, of course. Yeah,
And the best part is that no fund manager will accept the mistake. He says,
yeah.
of course, valuation was not at. That's why I didn't invest.
No, no. I think, yeah, it clearly is a miss for us. Yeah.
Okay, I'll just move to the next question. In terms of course, you talk about a lot of sectors where of course more, making it more concentration. You have again a miss, but making it more diversified. Yeah, practically no research analyst or no person can spend around 10,000, 20,000 hours to have a deep dive into a single domain. You
Hmm.
understand? But having a different domains and different thing, everything on the plate, don't you feel it's overwhelmed? Sorry if I'm going to ask that again, but just out of
Yeah,
curiosity.
I get it. I know, I get it. But I know what you're saying. But as I said, right, so we have very clearly, for example, from the mid-market fund that we run, because we don't look at deep technology, etc., right? Or,
Oh,
robotics and all, or real estate or all of that, right? So we clearly know which sectors we will not do, right? So that is, of course, extremely clear. And from the sectors which we do, again, we've built, remember that it's a 20-year-old platform as well, right? So it's
mm,
not a new platform, and we've built this knowledge over a period of time. I keep telling people that it's not only money that compounds, it's also
okay.
intelligence that compounds, right? So, when you spend years in the industry, I mean, now when a business comes to us, because again, like people like me who are at the platform, etc., we must, as I said, right, I would have met 15,000 entrepreneurs, if not, more. So it's it doesn't take time for us to kind of understand the business model in the sectors which we've looked at, right? We would have looked at so many transactions in these 7, 8 sectors that, and these seven, 8 sectors again kind of broken into several segments as well. And then of course we have our own ecosystem to talk to a lot of people in that specific industry very quickly. So we have created that, secret sauce where we are able to, for example, a laundry company comes to me. So in the next 7 days, some experts in that space I'll be able to reach out to and talk to them. So we that and that's how we kind of handle it. And we have never so far found on all of this overwhelming. And we get a few months to close a deal, so we have enough time.
Okay. And I think that's the edge of JM Financials when
Yes,
compared to
absolutely.
that.
Because the group support is huge. Yeah.
Yeah. And I'll just take one question from Patel is that what should be the return expectations for an investor when he's investing in startups, thereby compromising the liquidity and taking higher risk and course business risk, purely betting on the founder. So it's basically he's asking the return expectation for investors investing now.
Absolutely. No, great question. So I think, and again, it's very logical, right? So typically, if you start with the lowest risk in the equity side, it is Nifty, right? So if that is giving you a 12% IRR kind of thing over a decade or 15-year average, then you move to, say large cap, small. So if you're looking at, say, a mid cap, small cap mutual fund, then you are looking at, say, 18, 20% IRR, right? Then you move to the PEVC ecosystem, etc. Then you are looking at, say, at least north of 25% IRR, 25 to 30, right? So Obviously, now when you're talking about startups or very young businesses, the returns that you expect will be closer to 40 or even beyond, 40% IRR or so, because then only it makes sense, that you put money in that asset class, right? Otherwise, you have much less riskier asset classes if you want, if you're okay to for a lower return. So to me, that number is minimum of 40. And of course, depending on then the case specific situation, of course, it could be higher as well.
And also market specific situation.
Yeah, of course. Yeah, market specific. But no, honestly, Akshara, on the startup side, I don't think even if the markets are doing very well, on the listed side, and if you're deciding to allocate something on the startup side, unless the whole numbers only change. Say Nifty goes from 12 to 8, or 12 to 15. If those benchmarks change, then this will also change. But, in my example, say startup is coming as Nifty plus 28%. So if
Okay.
Nifty is the benchmark, then it's plus 28. So if Nifty moves, say to 8%, then of course you will say, okay, I am okay with 35% and not 40. But and Nifty moves to 18, then you'll say not 40 but 50. So everything is kind of relative.
Got it. So there's one question. I think, would JM Financial take investments for pre-IPO stage only if investor wants to? Because you have a fund in pre-IPO, right? If I'm not wrong.
Yeah,
So
that's
rather
a
than
separate
that,
fund. Yeah, that's yeah,
so
getting.
probably that one is what he wants to know about. And the second is that, does JM Financial make exit before IPO?
Yeah, sure.
So that is two questions that he wants to
Got it.
answer.
Perfect. So yeah, so two different funds. So one is the pre-IPO fund which Akshara is talking about. I think that's run by a different fund manager. So he would kind of come into companies which are say typically 18 months to an IPO. That's the logic. So the companies typically would have filed their DRHP or just about to file. So that will of course be through that fund. Coming to our PE fund where we've done three funds and soon fund four. Most of our exits are in fact much before the IPO. So like the
Okay.
packaging example I gave, we would kind of sell to a larger PE fund most of the times because we come in early, and then if company is doing well, then you have larger rounds of funding happening in the company in the next 4 to 6 years. So which is where we kind of get to exit. Of course, sometimes companies do extremely well and go public, which has also happened in our case. So in that case, of course, we would exit on an IPO. But if I have to give you a math, say if you have done 20 exits, not more than five would be at IPO. It would be, either a strategic sale or a exit to a larger PE fund.
So basically, before it's going to IPO, the exit happens.
Yes, much before.
Yeah, and we all, as you're being very, genuine enough to say about your mistakes as well.
Yes.
In the JM Financial's PE fund, there was a haircut from 9-year BFSI
Yeah.
investment in
Yeah.
2025.
Yeah.
Yeah, so 9 whole year, you hold a
Right. Yes. Yes.
sector
Yes.
or a stock. I mean a company for 9 years, and
Yeah.
still you had to exit on a loss.
Correct.
So where does
Absolutely.
the patient capital comes from?
No, no. So see what happens is that from a fund you typically invest in 10 companies, right? And we always bucket, and of course every fund manager would want all the 10 to succeed. But at least we have not been that fortunate still in the last 20 years. So you always have strong companies, stable companies, and challenging companies, right? And the hope is that the challenging typically does not cross 2 out of 10, right? That's the hope. And then stable would be, say, 3 to 4, and strong would be 3 to 4. So if you kind of, work around those, then you will typically meet your return expectations, which we spoke about, right, as a mid-market PE fund. So in this specific case, of course, this move to the business model was to affordable housing finance, where, you give home loans to a driver or that kind of segment, right? Unorganized segment, and it was a young company as well. And when COVID struck, it was a big challenge for them to kind of recover EMIs and all of that, and the debt equity was very high at that time. They were planning to raise equity, but then COVID happened, so the equity didn't come. So it was somewhere a situation where, as I spoke earlier, whatever had to go wrong went wrong, and then it was like a spiral downward sprint, that the loan book say if it was X rupees, it became 0.4x in another 3 to 4 years. So then of course it was becoming more and more challenging. So it was important that we kind of take an exit and return whatever we could return. So yeah, of course that happened.
Okay. And I'll just take one question from Akhil, is that from risk to reward perspective,
Yeah.
at what optimum stage should you invest? Seed or series A or close to IPO stage?
This he's talking about his own personal risk return relationship, or
In
or
general,
anyone.
in general.
No, no. So I think the relationship will stay the same, right? I think if you're asking me where is the alpha, I mean, where really, so,
Optimum
and
stage one can
yeah.
invest.
Yeah. So, and which is where the reason that we are playing in the mid-market opportunity, where, we are not, as a JM fund, not doing startups, neither we are doing very large companies, and touchwood, it has worked well because again, a very, very good, like in the last 20 years of investing touchwood, we have not had a single company where the company has closed down, right?
Okay.
Or is a complete write-off. We would have lost money, as you just saw in that 2025. Like, okay, if we invested 10 rupees, we got back only 6. But touchwood never has been a situation where we have had a write-off. So, given the mid-market space, because it is a business model that is already proven, you are not at a stage where it's going to be a complete write-off. And still, because so much growth is left, you could still end up having a very high return as well. So we, of course, that's why we like that space, and that's where we kind of play there. So that is, what we like as an asset class.
Okay. And I'll just take one question.
Yeah.
In 20 years, 38 investments you have done. Yeah.
No,
So
many, 30 plus, 35
30
odd,
plus.
35 odd.
Okay. 35 hour. So in that numbers, apart from valuations, apart from math, that apart from the word founder, there'll be one conviction that would have made you say that, oh, acha, I'll invest in this company. So what was that? Let's not
Okay.
take maths here.
Yeah. Of course. No, so we can take recent cases of spices which we had invested, right, 18 months back. So yeah. So not math and not so when sometimes when we take a call, it's more like, what is the new disruption that this
Ah.
business is bringing, right? And still staying in the mid market yeah, spectrum. That okay, so for example, spices is a typically a very regional brand scenario, right? A South will have a South brand, like whatever Achi Masala or something like that, right? A North will have a Salman Khan Goldi Masala, right? And Indore will have Pushp and all of that. So typical trends are like that, but we were always looking that this will also get disrupted,
Mhm.
through quick commerce and all that. And and then again, there was a trend that there was, again, in spices, there is either a blended spices, which is say a pav bhaji masala and all of that, or a CTC, which is your turmeric powder, etc., or whole spices. Whole spices is khada masala, like
Uh-huh.
a cardamom and all of that, right? Now, again, that space, if you see, it's a very unorganized space that which has no brand, etc., right? So,
Yes.
so this for us was a compelling opportunity, whether we can look at something where it is branding a whole spice and it is also moving pan India through quick commerce. So this was the thesis where we created a thesis and then found a company and invested.
I think that's interesting. I think it gives a different perspective because I
Yeah,
have seen a whole spice with a brand. It was,
correct.
it is available in a very small market only.
Absolutely. So, which
Very,
is where, Shilpa Shetty is the brand ambassador. You can look it up, So, and the packaging is very different and all of that. So, a very interesting, possibility which we saw, and that's how we kind of put money there. And touchwood, it's scaling extremely fast.
yeah, that's sure. And see, of course, I never felt the time was moving. We've
Oh, yeah.
already almost a hour since we started the webinar, actually. So I have a lot of questions to take, but I don't think so. I can take everything on air. So these
Sure.
questions will be mailed to you. So I
Okay.
request your team to approach them personally, or I know I'll be giving these questions. So these are answered, and
No, no,
can
I
you?
will for sure. I will personally look, answer. If you're going to give me the contacts and all of that, we'll make sure that we answer each and every question. Of course, the only caveat is that I'm going to be traveling extensively in the next 2 weeks, so please be patient. But of course, before in the next 3 to 4 weeks, we'll answer every question, unless just to be very clear.
I think that's most important in being a fund manager, being transparent to the clients. I think that
Yes.
is. So one last question I will take before closing. So
Yeah.
you've been in this market for last 20 years. And
Yes.
you've seen multiple cycles. You have
Yeah.
seen war, you have seen COVID, you have seen
Correct.
Lehman, so every other thing. So probably, what was the one scenario, macro scenario, that has affected,
Yeah.
the private equity, private market as such, and that there's a change from then. Is there any scenario of
You're
that sort?
talking about overall or for me? For me, I can tell.
Yeah.
Overall, I wouldn't know. Every fund manager would have a different view. But, interestingly enough, Akshara, when we've backed businesses and founders, Touchwood, right? Most of them have been able to stride these challenges, pivoting their business through demon, etc., something like that, etc. I think one thing that has hurt us the most, and that is an unfortunate part for our country and landscape, is sudden regulatory issues. So to give an example, in 2010 2011 we were hurt very badly that suddenly, and this was a southern state so you would know more, in the state of Andhra Pradesh, microfinance business was banned. Right? It was so unfortunate and uncalled for, and suddenly so many investors lost so much money, right? Similarly, in education, suddenly distance education was, kind of changed as a regulatory. Recently, you saw gaming going through its own issues because of regulatory, verdicts, etc. So, for us, this became a big learning immediately after the first fund, that we will stay away from businesses that are sensitive to regulations. That
Okay.
decisions can come. So, in fact, more than the demon, more than GST, more than the Iran war or anything else, this is something which we are very wary about. Is that, are we getting into situations which can have regulatory disruptions? And again, just very candidly, gaming was a hot piece of cake for a lot of years, and we had so many opportunities, but we just stayed away because somewhere in my heart I used to feel that, what if some court comes and says something, right? And which is what exactly happened a few quarters back.
So of course, now that's one thing that you don't regret now.
Yeah, not at
Oh my goodness.
all.
So I think with that, I would like to close this webinar. I need to thank
So,
all the participants on taking time on a Friday evening and being
yes.
patient throughout this 1 hour and being supportive and asking questions, making it more interactive. And thank you, sir, for educating us throughout.
Thank you. I hope I could add some value to all of you. Thank you so much for giving your precious time to me. Thank you.
Thank you, sir.